I'm going to be going through a business called the Ensign Group Incorporated, and then what I'm going to be doing is going through three other businesses that have been successful roll-ups and sort of go through how they can generate these massive returns. As you can see, this business has generated for its shareholders a 2000% gain, which equates to a 20x, meaning they've done that in 20 years, and that's about 20% growth per year in the stock price. Now, because this business is a roll-up, and all these are roll-ups I'm going to be talking about, I'll sort of go through the model, but effectively, in particular, this business specializes in the nursing and senior living segment and as well as rehabilitative services, and they basically operate these facilities which they then acquire, and they basically roll them all up, and on the private market these facilities often go for single digit earnings, meaning that they can be bought at like 7 times a PE effectively in the private market. They can then roll these up and acquire them continuously. They also do things such as deferring payments, which basically means the business can pay for itself by offsetting payments for a future date and just using the business's profits to fund that. Other things they do include taking out debt, as already mentioned, but also then cutting costs, and also just using the fact that they have some synergies there. I'm cautious when I use that term because a lot of roll-ups and companies acquiring other companies promise that. But the thing is, when you start to specialize in just buying out these one type of entities, you usually get pretty efficient at it. In particular, I like it where I can see specific types of businesses have particular characteristics which lend themselves to basically doing very well, getting bought out and rolled up. So what I'm talking about here is the fact that they can save on software costs, because as a group bundle they're going to get a much more favorable rate. The fact that a lot of their staff, if it was just a one facility business, it would mean that their staff sort of would be unpredictable, the demand off it for a lot of the time, just because certain facilities at some point will need more people than others, and they might not be fully equipped for that. So a lot of the time they have to pay out on overtime, which doesn't sound like a lot, of 50-100% increase on staff costs, but if that's happening fairly regularly because of these imbalances, then that can eat into profit margins significantly. And by having multiple facilities, you're able to smoothen that out a bit, and that certainly helps with profitability as well. So just certain factors like this, and also just becoming an expert and being able to apply these learnings from one facility into another. As you can see, this has worked really well for the business. The revenue has gone from 2.4 billion to 4.6 billion in the last 5 years, meaning almost 2x, 15% average growth. Profitability is done about the same, 170 million in 2020, 322 million in the last 12 months in 2025. Okay, so we know that's where that's come. So if you look at, for example, the last 20 years, and we just say, assuming the growth rate was the same, if you took earnings to double every 5 years, that would mean in 20 years earnings would go up 8 times. So we know that if the stock has gone up 20 times, that out of those 20 times, at least 8 has come from earnings growth. And because this has been a very successful roll-up with a proven model, as you can see, it currently trades at a P ratio of 31 times earnings. So there's obviously been some multiple expansion there as well, and probably a double up in multiple expansion there and there, but there or thereabout gets you to 16 times increase in stock price. So it is very realistic to occur if you can sort of spot this early, or you have confidence in management. So yeah, that doesn't get you far off your 20x return there, as well as just any capital they reinvest, obviously. Okay, so a few more examples we're going to be going through. One is Comfort Systems, again a roll up, and then what they do is they basically mainly do HVAC services as primarily part of their business. They effectively buy out these smaller businesses and they can basically take advantage of that and also do larger contracts, which these smaller companies might not typically be able to do. It's mainly services as well that they try and do, because that's higher margin segments, but it's basically in the mechanical and electrical installation space, that's kind of where they sit because they are a bigger company now, so they do a wider variety of services. Financially, having a look again, this is another really attractive model to sort of have roll-ups in, because again they sell for so cheap in the private market. Again, you're looking at 6 times earnings, and so each business you buy can effectively pay itself off in 6 years. Never mind if you take on debts, never mind if you structure it in a way where you have earnouts or you defer payments so that the business pays itself off without ever having to raise any outside capital, making it cheaper as well. Okay, so looking at revenue growth, on average you can see there it's been about 25% per year, which is very strong. Revenue having gone from about 2.8 billion to 7.7 billion in only 5 years. Net income hasn't been as strong, however it's still been fairly resilient, having gone up about 4.5 times over that period, from 150 million to 700 million. So again, I think it's fairly reasonable to see the growth here and why it's occurred. I mean, if you just look over the last sort of 20 years, call it from 2005, this stock was trading at $7, now at $792. There's your 100 bagger. That's on average a compound annual growth rate of about 26% off the top of my head for a 100x over 2 years. 10x over 10 years is 26% a year. That's how you can sort of know that. Okay. Again, you see it trades at a 40 times P ratio. Forward earnings of 32 times. So it does make sense as to why it trades there. I mean, it's been doing this decade after decade. There's a significant amount of trust there. Credibility has been built up. And also there has obviously likely been some multiple expansion on top of the initial sort of growth there. Okay, so we're going to be going into the next segment, which is one that hasn't been as successful, because obviously not every roll-up has been successful. Not to say that this isn't one that I think is going to work, because I do. But just to give you an example, I mean, over since 2007, it hasn't really done anything but go down. But I'm going to be going into a fair bit of context as to why. But I want you to focus on the business fundamentals rather than just the stock price, because ultimately the stock price is just a scoreboard. We're looking at how good the players are playing. So as you can see, let's use 2021 as a better representation. In fact, if we use 2019, that's the best representation there is. So in 2019, this business had about 150 million in revenue. I know it's not visible there, but I'm telling you, it's 150 million in revenue. Current day, or 2024, it was 350 million in revenue, so about a 2x again over 5 years. And the reason I say that is because Ring Energy is actually an oil company, so they acquire parcels of land. Their strategy is a bit more unique than just generic pieces of land that produce oil, but I'll get into that in a minute. And then basically they just roll those up and just continue reinvesting and growing their earnings, and that's how you sort of get to this revenue growth. So from 150 million to 350, that's about 2.5x over that time, so not bad. Again, that's about like a 16-17% growth rate there. Net income over that time, it's fairly hard to say because the prices of oil are so volatile, but I mean, more or less their earnings have been growing. Most recently it's been about 60-70 million, however that's pretty compressed. So another thing you have to take into account is that oil at the minute is about 60, or during these periods has been about $50-60, which is nearing towards modern historic lows. Obviously if you go back to 1980 or something, it's going to be much lower, but modern historic lows, it's been towards the very bottom of that range. So you have to take these earnings into account with a bit of grain of salt, and the fact that they're still profitable at this level just shows their strength. So I think the best way for me to really gauge this is looking at top line more or less. So what I particularly like about Ring Energy's model is that as an investor, I can clearly see where their growth is coming from. And what I mean by that is I can see that it's sustainable. So the thing that Ring Energy does very well is that most oil and gas companies anyway trade cheap, even in the public market, but even more so in the private market. They can trade at very cheap multiples, mainly because of the whole ESG movement. There's less demand for it, and also they're continuously draining assets, so they have to trade somewhat cheaper, and oftentimes they get a fair bit more discount because of that. So as a result, you can buy a lot of these oil players at 4 times earnings that they pay themselves off in 4, 5, 6 years, which can give you very high returns as an investor. And then what that also means is, because Ring Energy specializes in looking at oil assets which have historically done very well, but potentially been sort of seen as drained for all their resources, and no longer as valuable, they're then able to capitalize on that because no one really wants to buy them. They're able to get in at very good prices. These parcels of land are also not quite big enough for a massive place to be attracted to. In fact, they're probably the smaller size pieces that a lot of these bigger companies don't really want to keep. It's just sort of like an odd piece sat in their portfolio of oil producing assets. They'd rather something much bigger that they can focus their attention on. What this now means is that Ring Energy is able to buy them at very low multiples, and what they are able to capitalize on is the fact that their technology that they know, yes, it's been around in the market for 10, 15 years, but things like fracking that other players aren't as adept at doing, particularly the skill of being able to convert a piece of land that's once produced into one that's successfully already doing it, has a lot of time, a lot of cost associated with it, and a lot of risk should it not go wrong because you don't have the experience. So Ring Energy is willing to take all those risks, willing to invest and put the time into it. And the reason they're able to take that risk as well is because they've done it so many times. They have that experience of doing it, whereas other businesses won't have that experience because that's not what they specialize in. So Ring Energy is able to take advantage of that and generate outsized lasting returns because of that. So their return on capital can easily be 15% plus sustainably because of that. Hence the reason Ring has been able to grow at very sufficient prices. Now there has been some dilution and some things have happened in between that have sort of made the company a bit more of a rocky start than others that you see on this chart. They've not all been as graceful, and a lot of that has to do with the dilution wasn't necessarily bad. It was more sort of shareholder reaction to it. But it was more to do with the fact that they've got a fair bit of debt now, and also oil prices have started falling, so margins obviously come down, perceived risk is obviously going to be higher. Risk itself is actually going to be higher, although you could argue, is the market pricing it fairly? That's a different story, but the risk is still higher because now I'm not saying this is likely to happen, but should a scenario happen where oil prices for some whatever reason go to $45 for a very long period of time, this company is going to be put at jeopardy. Now I do not see that likely to occur because I believe a significant amount of players will go bankrupt way before Ring will, and that's effectively going to restore that equilibrium there in terms of supply demand. But as you can see, looking at the business fundamentals itself, this business has had a bit of dilution since, but I mean, it's grown its earnings 2.5 times over 5 years. It's focusing on paying back its debts, and reinvesting all that cash. And I think this could very easily be one that benefits as soon as oil prices start to recover. And I think that's just from the ability to grow. And now this is an investment advice, but it's just sort of my way of thinking about it from a business owner's perspective and just looking at the fundamentals of this business. I see their advantage sustained and continue to grow. And yeah, so there is obviously risk here. There's a lot of debt. There's a lot of things that could go wrong. This business could easily go bankrupt if the management aren't careful. So there's certainly things that you need to be careful with and cautious of as an investor. I mean, there is obviously some sort of reason behind why the stock price had fallen, but like I said, there is obviously risk here. But I just want to show you that there are examples that A, haven't worked out as well as you initially intend, but B, that you can still find these opportunities at reasonable valuations, I think. Okay, I'm going to move on to the next one as well. So this is probably the most famous example of a roll-up. If you've not heard this, then you probably aren't too familiar with roll-ups, but I do want to just cover it quickly because I think there is a fair bit to learn here. So market cap 87 billion, so obviously big company, 87 billion Canadian dollars, but still massive company. Constellation Software, for those of you who don't know, primarily focused on mission critical software, which all that really means is they basically buy software that's important to other companies. Without that company's without Constellation Software, the business finds it very difficult to function, or it's almost impossible to function without it. It's a critical part of the process, hence mission critical. And this business is a lot of those software companies by themselves often undercharge. That's an insight that Constellation Software has, so a fair bit of its model relies on that. And they also specialize in acquiring these smaller companies which aren't likely to be impacted by a significant competitor coming in and competing for market share. So they're just small enough to basically not be of interest in entering that space. Similar to like the likes of Ring Energy, in the sense of the parcels of land they buy aren't as big to potentially want to attract a major player in the space. Again, if we look at the financials, last 5 years, Constellation Software has more than doubled, going from 4 billion to almost 11 billion. That's about a triple, maybe just under. Profitability wise, again, if we look at bottom line, it's not been as strong, frankly. 400 million. Now you have to take that 400 million with a grain of salt, seeing as they did have a fair bump from COVID. But even if you say 300 million to 640 million, again, it's just about double. So it's not bad at all still. So as you can see, significant growth is going to come from the earnings growth over time, just being able to keep on acquiring these businesses that, yeah, they don't trade as cheap as, for example, HVAC business might. They might still be, you know, double-digit PEs, but they'll be able to take on debt, defer payments, and also bump those prices over time, which is going to exponentially increase margins. And as you can see, last 20 years, this company has gone from $18 to $4,000. That's, I think, a 300x off the top of my head, if my maths is correct. Again, significant results. There you go, 23,000x. That's 23,000% gain, which is ridiculous, almost unheard of. And again, a lot of that just comes from earnings growth over time and multiple expansion, and the business just reinvesting its capital. It's like a combination of those three factors. But one thing I want to see in particular is, like, if they're going to acquire the company, what are they going to get just beyond the word synergies? Because almost every management team says that when they acquire a company. To me, at this point, it doesn't really mean anything unless you can directly point out what it is exactly that the business is going to get out of this. Then I can see where your returns are for me as an investor. So for me, with Ring Energy, I know if they're going to buy a piece of land, it's going to be it's going to be cheap. So already, because it's like a 5 times earnings, I know that it's going to pay itself off in 5 years. That's already like in my mind, that's already like a 15-20% return. And then on top of that, if I know that they're going to be able to add a bit of value there because of the land they're buying is they're able to squeeze more oil out of it because of applying new technology to it. Yes, they have some investment, but still, that's again going to bump the return slightly higher. Or if I know with Constellation Software, for example, that, oh yeah, they're going to buy these software companies, yeah, they're going to be about 10-15 times earnings, but then on top of that, I'll be able to bump prices and double my margins over the next 3 years. Then again, I know I'm going to have a certain return. Now, it's obviously not all black and white. There is a bit of judgment in here. But again, if you're able to see what distinguishes them, that's going to be a big one. I mean, the likes of Ensign Group that we mentioned earlier, the fact that they can save on software costs, and they're also going to save on the fact that their workforce is going to be more balanced over time. That's going to help them significantly because they have that network in place. That's going to help them. And you have to think as well, whenever a company gets acquired, there's obviously savings, but there's always going to be what I like to call de-savings, which is basically the opposites occurring, where people are leaving because they don't want to be part of a larger organization. And there's other certain hidden expenses where the culture might not be as good. It's harder to manage as many people, so you need more management in place. That's more expensive per head on average, or something like that. So there's always going to be de-synergies as well. It's something that you need to take into account, and just whether the overall benefit is greater than the cost, essentially. So that's why I need to be really specific, because chances are if you can't name me something really specific, you probably don't have anything that specific, and chances are net it balances out at best. So hope that was good. Let me know what you think.